Okay, so let's continue from where we left last time. So last time we discussed how to compute what we were calling the diluted earnings per share. We discussed how to compute a diluted earnings per share of the company. And we were saying, if you as a company by the end of the year, you have what we were calling the potential ordinary shares, which we were also calling dilutive factors, we said when you as a company have those dilutive factors, or what we were calling potential ordinary shares, over and above you computing what we were calling the basic earnings per share, you as a company, you are also required to compute what we were calling the diluted earnings per share. So we went through and saw how do you compute the diluted earnings per share when you have those potential ordinary shares by the end of the year. When you have those potential ordinary shares by the end of the year. We listed the potential ordinary shares by the end of the year and how to use them to compute the earnings per share. For example, we were saying, suppose by the end of the year, your earnings as a company were 10 million. The earnings of your company were 10 million. And then we were saying, maybe the number of shares by the end of the year, the weighted average number of shares by the end of the year were 2 million. And so we were saying, your normal basic earnings per share, your normal basic EPS will be 10 million divided by 2 shillings, at 2 million, that comes to 5 shillings. So that was what we were considering as our basic earnings per share, as our basic earnings per share. Then we went further and said, what if you have some potential ordinary shares by the end of the year, which are likely to give the holders the opportunity to own shares? How then do they affect the earnings? We said, if your company by the end of the year, they have a potential ordinary share, then over and above them computing the basic earnings per share, we said such a company is also required to calculate what we called the diluted earnings per share. And so we went through and listed the various potential ordinary share and how to use them. For example, we were starting with an example where we had a convertible, maybe 10% convertible debenture, 10% convertible debenture as one of the potential ordinary share, and we were assuming let it be 10 million. So how are we using it to compute the diluted? How are you using that potential ordinary share called convertible debentures to compute the diluted? We were saying this, listen, we were saying if your basic earnings per share is 5 and by end of this year your company still has a convertible debenture, then listen, if these debenture holders had converted, if the debenture holders had converted their debentures, the moment you had issued to them the debentures, suppose they had converted, if they had converted, then we said our earnings for this year, would no longer be 10 million. Our earnings for this year would no longer be 10 million. Our earnings would have changed. So we said to compute the basic, the diluted earnings per share, to compute the diluted earnings per share to the earnings we used for basic EPS, which in my case I'm assuming to be 10 million, we said you now add what? We said you add the interest, the debenture interest, net of what? The debenture interest net of what? Net of tax that would have been saved on conversion. I hope you remember that. We said you add to the earnings used for basic EPS, you add the debenture interest that would have been saved on conversion. In other words, we were saying if these debenture holders had converted their debentures, the moment we issue to them, whether at the time we issued, suppose they immediately converted their debentures into ordinary shares, it means this year we would not have paid them the debenture interest. We would not have paid them debenture interest. In other words, as a company, we would have saved that debenture interest. So our earnings would have been more. Listen, we said our earnings would have been more, but I hope you still remember, we said your earnings would increase by the debenture interest that would have been saved net of what? Net of tax. For example, we said If your company had a 10% debenture whose value is 10 million, it's true you paid them interest of 1 million. It's true you paid them debenture interest of 1 million. But now, to the 10 million earnings used for basic EPS, we said you don't add the 1 million. I hope you remember. We said you don't add the 1 million. Instead, you add that 1 million net of tax that would have been saved. How much is the interest net of tax? So we were assuming, suppose the tax rate is 30%. So we were saying 30% of 1 million is 300. Remove that tax effect from that 1 million, and that leaves you with 700. So you would have added, if the tax rate was 30%, to the 10 million earnings, to the 10 million earnings used for basic EPS, you would have added 700,000. You would have added 700,000 because you paid them 1 million, which is the interest. 10% of 10 million is 1 million. But we are saying you add it net of tax. You add it net of tax. That's what we said. Then we also went further and said, to the number of shares used for basic EPS, to the number of shares used for basic EPS, which in our case is 2 million, then you would add the number of shares to be issued on conversion, the number of shares to be issued on conversion, which for now I want to assume maybe you agreed you will give them 1 million shares. If they convert, you will give their preference shareholders 1 million, whatever it is. Okay, so that's what we said. So that is what you will add to the number of shares used for basic EPS, 2 million, add the 1 million. Then to the earnings used for basic EPS, which in our case was 10 million, add the 700, which is the interest saved net of what? Net of tax. Net of tax. That's what we had said. Okay. Now, then you compute what we were calling the diluted EPS. We went further and said, what if your company had a 10% convertible, again, 10% convertible preference shares, 10% convertible preference shares. Let me assume another 10 million. Okay. We said, if by the end of the year, now listen, if by the end of the year, now you don't have the convertible debentures, but you now have the convertible preference, that is another potential ordinary share. That's another potential ordinary share. So if your basic by the end of the year again was 5 shillings, and maybe by the end of the year, your company now has a 10% convertible debenture, then we said, had this preference, or 10% convertible preference, if the preference shareholders had converted their preference shares into ordinary, then, listen, we had said, listen now, the moment we issued the debenture, the preference, the moment we issued the preference, we said, had they converted their preference shares into ordinary shares, as a company, we would have saved what? We would not have paid them what? We would not have paid them dividend. Remember, they have been earning dividend for this year. They have been earning preference dividend. But we were saying, if they had converted their preference into ordinary, the moment I issued to them the debenture, whichever the time, if at that time when I issued the preference, if by that time when I issued the preference, had they converted their preference into ordinary, then it means this year, what I paid them as preference dividend, I would have saved that amount. I would have saved that amount. So we said, if by the end of the year, your company has a 10% convertible preference and the earnings were 10 million, to that earnings of 10 million, now when you're computing the diluted earnings per share, we said your earnings would have changed. If the preference shareholders had converted, would our earnings still remain 10 million? We said the answer is no. Our earnings for the current year would have increased by how much? By what we pay to them this year as dividend. 10% of 10 million is 1 million. So as a company, you must have paid them 1 million in terms of preference dividend. So you add to the earnings attributable to the ordinary shareholders for basic EPS, you now add that preference dividends of 1 million. You now add that preference dividends of 1 million. That's what we had said. Then, to the number of shares you used for basic EPS, we said, add the number of shares that would have been issued on conversion. Add the number of shares that would have been issued on conversion. And we were assuming, suppose the question told you, if the preference shareholders converted, you would have given them preference, you would have given them 1 million ordinary shares. So to the 2 million number of shares used for basic EPS, we would have added the 1 million, which is the number of shares to be issued on conversion, okay? So that was all about that. Then you now compute the diluted earnings per share. You now compute what we were calling the diluted earnings per share, okay? That is it. Then for these two, we said, if the convertible debentures or the convertible preference, I hope you still remember, if the convertible debentures or the convertible preference were issued in between the year, in the current year, within the current year, then we said the conversion is assumed to be with effect from the date of the issue. For example, if your company had issued them on 1st of July, if your company had issued the convertible debentures on 1st July, then remember, you did not pay the debenture holders interest for the whole year. You only paid the debenture interest for 6 months. So that is what you would have saved. Had they converted the moment I issued to them the preference at the debenture, which was on 1st July, had they converted that time, I would not have paid them interest for 6 months. That is the same interest that you would have saved on conversion, which in our case would have been 10% of 10 million for 6 months, which is 6 over 12. You paid them 500. You paid them 500,000. You would have saved it net of tax, and that's what you would have added to the earnings used for basic EPS. Okay. Then we said, if the debentures were issued many years ago, in other words, if the debentures were outstanding as at the beginning of the year, then we said the conversion is assumed to be with effect from the beginning of the year. Sawa. The same applied to preference shares, that if the preference shares were issued in between the year, then you only paid preference shares their dividend for a portion of the year. So if you issued the preference shares on 1st July, then you did not pay them dividends for the whole year. You only paid them dividend for 6 months. That is what you would have saved. Had they converted on 1st July, you would have saved that 500,000, which is 10% of 10 million for 6 months. You as a company, you paid your preference shareholders a dividend of 500 if the debenture at the preference were issued on 1st July. Then we said, if the debentures were issued on 1st July or the preference shares were issued on 1st July, then we said the shares to be issued on conversion that time, must be weighted on time basis, So I hope you still remember that. Then from there, we went to another potential ordinary share, which we were calling what? Stock option. And we were assuming, suppose your company by the end of the year has agreed with the employees, that they will be given a privilege of buying 1 million shares at a price of 15 when the market price was 20. I hope you still remember how to use the stock options to compute what we were calling the diluted earnings per share. I hope you still remember how we were using them. What were we saying? By end of the year, the company still has a stock option. We had agreed with the employees, whatever time we agreed with them, that they can buy shares at a price of 15, but not 20. So we had agreed with them that we shall give them that privilege to buy 1 million shares from our illustration. But come the end of the year, they still have not exercised. Listen, we say, if they had exercised that right, the moment we signed the agreement, had they exercised the right and bought the shares, this year our earnings were 10 million. But had the employees bought the shares, would our earnings have changed? What did we say? the earnings currently are 10 million. But had the employees bought the shares on the day we signed the agreement with them, would our earnings for this particular year, would they have changed? We said no. We said no. So when you are computing the diluted earnings per share and your company had a stock option, we said to the earnings used for basic EPS, you don't add anything. You don't add anything. In other words, the earnings will not change. The earnings will not change. Why? Because we said whether they exercise or they don't exercise the right and buy the shares, the earnings of the company don't change. In other words, we said nothing in the income statement changes. Nothing in the income statement changes. That's what we said. Okay. Then from there, tukasema, what about the denominator, which is the number of shares? Our current number of shares are 2 million for basic EPS, but we had signed an agreement with the employees that they can be given the privilege to buy 1 million shares at a price of 15 instead of 20. What did we say about how they affect the numbers? When you are computing the diluted earnings per share and you had a stock option, what did we say? What did we say? When there are stock options in your company, what did we say? I hope you still remember. We said this. Listen. We said when a company issues shares by way of stock option, listen, you know, some of those shares we said are deemed to be issued at full market price, and some of them we said are deemed to be issued as bonus. So whenever there is a stock option, part of the shares to be issued normally are considered to be issued at full market price, and some of them are deemed to be issued as bonus, and some of them are deemed to be issued as bonus. Then we said, when it comes to computation of the diluted earnings per share, not all the shares that are issued as stock option or will be issued as a result of a stock option, not all of them are considered to be dilutive. Not all of them are considered to be dilutive. We said only which ones? When you are computing diluted EPS and the company has a stock option by the end of the year, yes, the company has agreed with the employees, they will be given the privilege of buying 1 million shares at a price of 15 when the market price is 20. But they have not bought. But they will buy the shares in future at 15. So we said not all of the shares, 1 million shares, are considered to be dilutive. We said only the bonus share element, only the bonus share element, I hope you remember, only the bonus share element in the stock option are considered to be dilutive, okay? So we said you compute the number of shares that are bonus out of the 1 million. How are we computing them? How many shares out of the 1 million are considered to be issued as bonus? What did we say? We said to separate the number of shares out of the 1 million which are deemed to be issued as bonus, we said from the stock option, when they will be paying, they will pay as 15 million because they will buy one share at 15, but they are given the privilege to buy the 1 million shares. So when they will be buying the shares, they will bring to the company 15 million, but they will bring in that 15 million when the market price per share is 20. When the market price per share is 20. So we said their 15 million is not enough to buy 1 million shares. Their 15 million would not be enough to buy 1 million shares. It would be enough to buy only how many? 750, which is 15 million divided by the market price, which is 20. So their 15 million would be enough to buy 750. But we said the moment they will bring to the company 15 million, as a company, we shall not give them 750,000 shares. We said we shall give them only we shall not give them 750, we shall give them the 1 million. So if we shall give them 1 million out of their 15 million, we shall give them 1 million out of their 15 million, then we said it is obvious out of the 1 million, some of those shares will be deemed to be issued at full market price, which is how many? 750. And the other 250 will be said are the ones to be considered to be issued as bonus. Listen, to be issued as bonus. So when there is a stock option by the end of the year, you must separate how many of the shares will be issued at full market price and how many of them will be issued as bonus. Once we separate, listen now, once we separate, we said it is the bonus share element, it is only the bonus share element in the stock option that will be considered to be dilutive, that will be considered to be dilutive. That's what we said. Only the bonus share element in the stock option that will be considered to be dilutive. So to the number of shares you used for basic EPS, which in our illustration here we are looking at 2 million shillings, at 2 million shares, to those 2 million shares, you will now add only the bonus share element, only the bonus share element in the stock option, only the bonus share element, which in our case now is that 250, which is now that 250. To the 2 million, you only add the bonus share element. So I hope you have understood that, and I hope you remember what we said. Then we went to the next one, and the next one was maybe by the end of the year, your company had partly paid shares. Your company had partly paid shares. Maybe your company had issued, listen, your company had issued 1 million shares at a market price of 20, but come the end of the year, the shareholders had only paid you 15 shillings per share. The shareholders had paid you only 15 shillings per share. Listen. So when we were computing the diluted earnings per share, and we came across a scenario where your company, by the end of the year, they have partly paid shares, we said, listen, partly paid shares are considered to be dilutive only when one condition is met. What was that condition? Only when one condition is met. What was that condition? Partly paid shares are considered to be dilutive only when one condition is met. What was that condition? We said partly paid shares are considered to be dilutive only when there is a what? Only when there is an increase in the market price per share since the date of the issue. Only when there is a market increase in the market price per share since the date of the issue. So if the market price now is no longer 20 but 25, if the market price now is no longer 20 by 25 by the end of the year, then these partly paid shares by the end of the year will be considered to be dilutive. But then how do we use them to compute the diluted EPS? Again, listen, to the earnings used for basic EPS. Listen, we were arguing this way. When we issued the shares, we issued 1 million shares at a market price of 20. But so far, they have only paid us 15. So they are yet to bring in the balance of 5. We said, the moment they will bring in that 5 million, would our earnings in the income statement change? We say no, it doesn't change. Even when they shall bring in the balance of 5 million, which is 5 shillings per share times 1 million, the earnings of the company will not change. So we said, as far as dilution is concerned, the earnings will still remain 10 million, which means they will not change. They will not change, okay? That's what I'm hoping you remember. But again, to the number of shares used for basic EPS, listen, to the number of shares used for basic EPS, which in our illustration is 2 million, we say to those 2 million, you add what? To those 2 million, we said you add what? Do you add the 1 million partly paid shares? No. What did we say you do? You add what? We said to the 2 million shares, you will add the bonus share element. You will add the bonus share element in the partly paid. The bonus share element in the partly paid. So how are we computing the bonus? How are we computing the bonus share element? We had said this. Listen. The moment the shareholders bought the 1 million shares as partly paid, don't forget, we said when shares are issued and they are partly paid, listen, when shares are issued and they are partly paid, we said you only consider them. If you remember, when we were discussing basic EPS, we said when shares are issued and they are partly paid, we said for purpose of basic EPS, they are considered only to the extent that they are done what? Only to the extent that they are fully paid. So out of the 1 million, not all of them were used for computation of the basic EPS. No, only the ones that are considered to be fully paid. In other words, we said only to the extent that they will participate in dividend. Okay? So when we were computing the basic earnings per share, out of the 1 million, how many were you supposed to add? Only those which are considered to be fully paid. So those are the ones you issued and they are considered to be fully paid. Which in our case we were saying, these guys brought in how much to the company? 1 million shillings, 1 million, they bought 1 million shares at a price of 15. So they brought in 15 million. But they brought in at a time when the market price was 20. So we were saying, their 15 million is only enough to buy how many shares? Only enough to buy 750. So out of the 1 million, listen, out of the 1 million, those are the ones considered to be fully paid. Those are the ones considered to be fully paid. Listen, then we said, the moment they will bring in the balance, I hope you are following, the moment they will bring in the balance of their 5 shillings per share, on their 1 million, they will bring in the future another 5 million shillings. They will bring in another 5 million shillings. We said, the moment they will bring in the other 5 million balance in the future, you as a company, you will give them the balance. Listen, you will give them the balance of the shares to the extent that they are fully paid. We said you will give them the balance of their shares. You will give them the balance of their shares to the extent that they are fully paid. So far out of the 1 million, you have issued 750. And those 750 are already participating in dividend. But I said, the moment they pay me the balance, you as a company, you will issue another 250,000 shares, the balance of their shares to the extent that they are fully paid. Okay? Listen now. So we were saying, if in the future they will bring in 5 million, and you as a company, you will give them 250,000 shares. That's what you will do. But suppose they bring in the 5 million at a time when, listen, at a time when the market price per share is no longer 20, but the market price per share is 25. So there are 5 million that they will bring in future. At a time when the market price will be 25, their 5 million, listen, will not be enough to buy, their 5 million will not be enough to buy the 250,000 shares that they will get. We said their 5 million will be enough to buy how many? These guys will bring in, they will bring in an amount of 5 million in future, and they will be paid, and they will be given 250,000 shares. But we said, what if they brought in the 5 million at a time when the market price is no longer 20 but 25? So their 5 million in that future will be enough to buy only how many? Only 200,000 shares. Listen. But the moment they will bring in the 5 million, we shall not give them 200,000. We shall not give them 200,000 shares. We said we shall give them the 250,000 balance of their shares. We shall give them their 250,000 balance of their shares. Because so far out of the 1 million, we issued 750 as fully paid, but the balance will be given in the future, which is 250. But that 5 million they will bring in the future, suppose they bring it in at a time when the market price is 25. So we said in that case, their 5 million should be enough to buy only 200,000 shares. But they will not get 200,000 shares, they will get 250. So out of the 250, it's like 50,000 of those shares will be given for free as bonus. Out of the 250, it's obvious, it's like 50,000 shares will be given to them for free. Those 250,000 shares are the ones we said will be considered to be dilutive, And those are the ones we said you now add them. Listen, those are the ones we said you now add them to the number of shares used for basic EPS, which in our case, our number of shares used for basic EPS, you remember, were 2 million. So when I'm computing the diluted earnings per share and your company has a partly paid share, then we said use only the bonus share element in the partly paid and add it to the number of shares used for basic EPS. So to 2 million, you would add the 50,000 shares. I hope you remember. Then you compute whatever is the basic earnings per share. Listen now. So those are the 4 items we talked about and used them on how to compute what we are calling the diluted earnings per share. But now I want to develop the topic further. Now we want to develop the topic further, and that's what we left now. So we said, but suppose, listen to this now, but suppose by the end of the year, yes, your company had earnings of 10 million, earnings of 10 million. Yes, your company had earnings of 10 million. And the number of shares were 2 million. It's true your basic EPS was 5 shillings, which is 10M divided by 2M. That gives me 5. But then we said, what if by the end of the year, that's where we stopped. What if by the end of the year, your company now has more than one potential ordinary share? We have been discussing, even just right now, we have been discussing how to compute or reminding ourselves how to compute the diluted earnings per share only when by the end of the year you had a 1 potential and then you calculate diluted. Maybe only one in your company, only one by the end of the year, and how to use it to compute what we are calling the diluted earnings per share. But now we are saying, what if your company has more than 1 potential ordinary share at the end of the year? At the end of the year, it could be your company has a 10% convertible debenture, convertible debentures worth 10 million. At the same time, maybe your company by the end of the year had another 10% convertible, had a 10% convertible preference shares, convertible preference shares worth shillings 10 million. Maybe at the end of the year also, your company had a stock option by the end of the year. Maybe your company had a stock option or even partly paid shares. So when your company, listen now, when your company has more than one, when your company has more than 1 potential ordinary share, you have to use all of them to compute only one diluted earnings per share amount. And that's what we want to talk about now. When you have more than 1 potential ordinary share, how do you use them in computing? The diluted earnings per share? So let me go through now and explain how to use them to compute what we are calling the diluted earnings per share. Now listen. For each of these potential ordinary shares that you have by the end of the year, for each of them, you as a company now, you will be required to calculate, what we call the incremental earnings per share. For each of them, you as a company will be required to calculate what we call the incremental earnings per share. Once you compute the incremental earnings per share for each of them, then you rank them. Now listen, you rank them according to their degree of dilution. You rank them according to their degree of dilution. Once you rank them according to their degree of dilution, then use them according to their degree of dilution to start diluting your basic. One after the other. Remember, our basic was 5 shillings. So whatever is the potential ordinary shares, use them according to their degree of dilution to start diluting the 5. So the question is, which one of them will I start with? Which one of them will I start with to start diluting your basic? Which of the potential ordinary shares do you start with? You start with, listen, you start with the one that is considered to be the most dilutive. You start with the most dilutive and you end with the least dilutive. You end with the least dilutive. For that, let me illustrate. So I'm assuming your company had, by end of the year, 10% convertible debentures worth 10 million. I am also assuming the debentures were issued many years ago and you had agreed with the debenture holders anytime they want to convert their debentures into ordinary, I'm assuming you will give them 1 million shares. That's what you agreed. At the same time, by the end of the year also, you had as a company a 10% convertible preference. You agreed with the preference shareholders when you are issuing the preference shares many years ago that if they want to convert, you will give them another 1 million shares. You will give them 1 million ordinary shares if they want to convert. Come the end of the year, your company had a stock option of giving the employees the privilege to buy 1 million shares at a price of 15 when the market price was 20. When the market price was 20. So, and they have not done it. So for each of them, you calculate what we call the incremental earnings per share. And that's what I want to talk about now. How do you compute the incremental earnings per share? Now listen. So for that, I want to prepare a table where we shall be identifying the item we are calling potential ordinary share. After that, we shall be having another column called incremental earnings. Whatever are the incremental earnings, that will be there. The other one will be the incremental number of shares, incremental number of shares. The other column you will need, maybe I should squeeze, maybe let me squeeze so that I create enough space. Let me squeeze. I have already said you will need a column called incremental earnings. You will need another column called incremental number of shares. Then you will need another column called incremental EPS. Incremental EPS. And then you will need another column we shall be calling the ranking. So for each of them, which is our potential ordinary share, let's start with the first one. The first one was what we are calling convertible debentures. Convertible debentures. You will need to ask yourself, listen, if these debenture holders had converted, would our earnings have changed this year? If they had converted the moment I issued them the debentures, had they converted, would our earnings for this year, would they have changed? Remember, our earnings were 10 million from the way I was illustrating. That was what we used for basic. But had they converted, these debenture holders, had they converted, would our earnings have changed? We saw, yes. So you come and say, what effect would it have on the earnings? It is obvious the earnings would have increased by what? By the debenture interest. By debenture interest done what? Saved. By the debenture interest that would have been saved. This year, what is it that you paid them as interest? Our company has a 10% convertible debenture worth 10 million. So it is obvious that this year, you as a company, you paid your debenture holders 1 million. But we have said that interest of 1 million will not be the one to increase the earnings by the whole amount of 1 million. We said it will increase the earnings by the amount of interest net of what? Net of tax. Meaning it will be 10% of the 10M, multiply that by 1 minus the tax rate, which is, I'm assuming, 0.3, which I am assuming is 0.3. That is the tax rate. That amount, or the 30%, is what we are calling the tax rate, okay? So we need to go now find out what will be the incremental earnings. It is obvious we paid them 10% of 10 million, which is 1 million. 30% of that 1 million is 300. Net it against that, and you are now remaining with a balance of 700,000. So our incremental earnings would be 700,000. Okay. Then you ask yourself, from the agreement, if these guys who agreed to convert, if they want to convert their debentures into ordinary, how many shares would we issue? We would issue to them 1 million shares. So our number of shares will increase by 1 million. Our number of shares would increase by 1 million. Then you compute what we are now calling the incremental EPS, which is 700 divided by 1 million. 700 divided by 1 million, that looks like 0.7. That looks like 0.7. Then you go to your next potential ordinary share, whatever it is, which from our illustration, we are assuming it is the 10% convertible preference shares. The 10%, no, sorry, before you, yeah, sorry. Maybe what you could do, let me explain properly now. Let me explain properly so that we put it correctly. After analyzing the effect on the earnings, then they can come and say your number of shares. You can now come and say your number of shares. We have agreed that you had agreed with them that if they want to convert their debentures into ordinary, the number of shares you give them is 1 million. So that 1 million becomes your incremental number of shares. 1 million becomes your incremental number of shares, your incremental number of shares here. Then you now come and compute the incremental EPS by taking the incremental earnings, divide that by incremental number of shares, that gives you 0.7. That is what we are saying. Then you now go to the second, potential ordinary share, and that is what we are referring to as convertible preference. Convertible preference. Again, you ask yourself, if these guys had converted, what effect would it have on the earnings? What effect would that have on the earnings? Had they converted, as a company would have saved what? Preference, dividend. We have been paying them dividend, but had they converted, we as a company would have saved it. We as a company, we would have saved it. Our company has a 10% convertible preference amounting to 10 million. So every year, we must have been paying them 1 million shillings as dividend, which is 10% of 10 million. That must have been the amount we are paying them as dividend. That is what would have saved. 10% of 10M, that comes to 1 million. That comes to 1 million. That would be the incremental. Don't forget, we said dividends are not subjected to tax. I hope you remember. We said dividends, you don't subject them to tax amount. No. Then from there, we went and said, what about the incremental number of shares? If the preference shareholders decide to convert, what would be the incremental number of shares? Maybe from the question, number of shares, maybe from the question, the agreement was, if they want to convert their debentures into ordinary, maybe we'll give them another 1 million shares. So that becomes the incremental number of shares. That is 1 million. Once you do that, now you compute what we are calling the incremental EPS, the incremental EPS, which is 1 million incremental earnings divided by 1 million incremental number of shares. That gives me an EPS of 1. That gives me an incremental earnings per share of 1. So that's all for the second one, and therefore you go to the third one and the fourth one if they are all there. But for now, let me assume using only 3, and the next one is what we have called stock option. By the end of the year, your company had some stock option. Remember, we were assuming that your company had agreed with the employees that if they want to convert their debentures, if they want to buy shares, they will be given the privilege of buying 1 million shares at a price of 20, at a price of 15, when the market price is 20. So by the end of the year, they have not bought. There is still potential. They have not bought. It's still potential ordinary share. So how do you use them? Tukasema, what effect would that have had on the earnings? If these employees had exercised, listen, if these employees had exercised their right and bought the shares, would our earnings have changed? Would our earnings have changed? I told you that even if they buy, nothing in the income statement will change. Even if they buy, nothing in the income statement will change. So in fact, therefore, we said that the effect on the earning is nil. There will be no increase in earning. That means the incremental number of earnings will be 0. Then we come and now say, what about to the number of shares? What about to the number of shares? I hope you still remember, which I've just reminded you today, that we have said, when shares are to be issued on the exercise of the stock option, some of those shares are deemed to be issued at full market price, and some are deemed to be issued as what? As bonus. Listen, as bonus. Then I told you, not all the components of the stock option are considered dilutive. They are out of the 1 million. I'm assuming we are issuing 1 million at a price of 15 instead of 20. Out of the 1 million, we were seeing 750,000 shares will be bought at full market price. But I was saying, the moment they bring in 15 million, you as a company will not give them 750,000 shares. You will give them 1 million. That's what we agreed. That's what we agreed here. By the end of the year, we agreed that in case in future they want to buy shares, they will be given the privilege of buying 1 million shares at a price of 15. But the market price is 20. When we were signing that agreement, the market price was 20. Now we are saying, listen, not all the 1 million shares are considered to be dilutive. Only the bonus share element in that are considered dilutive. So when I'm computing diluted earnings per share, you calculate the number of shares which are considered as bonus. The number of shares that are considered as bonus. How do you get them? You take the 1 million number of shares that you will issue. Out of that, remove the ones, listen, remove the ones that are considered to be issued at full market price. How do you get them? It would be 1M times 15, because that's what they will pay per share. Divide that 15 million by the 20 shillings. By the 20 shillings, whatever it will give. So we are now saying this whatever is in the bracket, this whatever is in the bracket is obviously at full market price, because they will buy 1 million shares at 15 shillings. They will give us 15 million. But if that 15 million is what they used to go to the stock market to buy shares, they will find the shares being sold at 20. So that means their 15 million will not be enough to buy 1 million shares. Their 15 million will only be enough to buy 750. But the moment they bring in 15 million to the company, you as a company, you will issue to them 1 million shares. So out of the 1 million, how many are deemed to be issued as bonus? It is the 250,000 shares. That is 250,000 shares. Those are the ones that are considered to be dilutive. Then, now you have incremental earnings of 0. Our incremental number of shares is 250. Automatically, therefore, the incremental EPS will be 0. Listen now. Once you compute those three figures from this illustration, once you compute those three incremental earnings, then I said you rank them. You rank them according to their degree of dilution. You rank them according to their degree of dilution. So, okay? Now, so we want to know which of these three potential ordinary shares are considered to be dilutive. Most dilutive, most. You start with the most dilutive. Then you end with the least dilutive. Okay? Now listen. 4. The most dilutive, maybe I can simplify that. The most dilutive is the one, the most dilutive is the one with the lowest. It is the one with the lowest incremental earnings per share. Listen, our earnings currently were 10 million. The number of shares, you remember, was 2 million. That gave us a basic EPS of 5 shillings. But we have three potential ordinary share. We are saying start with the most dilutive to dilute that 5 shillings. So the most dilutive is the one with the lowest incremental earnings per share, which in our case is the stock option. Why is it the most dilutive? Because our earnings, which are the numerator, will not change. They will increase by 0. But the denominator will increase by 250. The 1 million or the 2 million shares you had will increase by 250. But the earnings will go up by nothing. So that means it is the stock option that will dilute more I will dilute to a greater extent the earnings of the existing shareholders because they are not gaining anything, yet the denominator is increasing by 250. So the most dilutive potential ordinary share is the one with the lowest, incremental earnings per share. So in the column of the ranking, in our column of the ranking, then we start with the stock option as number one. We start with the stock option as number one. Then you go to the next most dilutive, and now you go to the one again with another lowest incremental earnings per share, which in our case here is convertible debenture. That becomes number two. Then finally you go to number three, which is the convertible debenture. Now listen, once you compute or you rank them now, now you can use your three potential ordinary shares to compute what we are calling the diluted earnings per share, okay? So how do you dilute the earnings? You come and state now, we are saying our basic, you need to get the earnings, get the number of shares, and you get what we are calling the EPS now. You get the EPS. So you start with the one which you considered as basic EPS. To get basic EPS, we use 10 million, which were the earnings. The number of shares were 2 million. And therefore you got EPS of 5. Now start diluting it. Using the potential. Starting with which one? The most dilutive. Which one? Stock option. That is what we saw. If the employees exercised their right and bought, our earnings will still not change. That's what we have agreed. Then we have said, out of the 1 million shares that were given or will be issued, 250,000 of them are considered to be bonus. Those are the ones we said are dilutive. So this will give me 10 million. Divide that now by, this will now give me 2,250,000. Somebody with a calculator now, what becomes the EPS now? What becomes the EPS? So let's take the 10 million. We divide that by, we take that 10 million. We divide that by 2,250,000. 2,250,000. What do you get as the basic, as the EPS? You get it something like 4.4 to 1 decimal point. Okay, that is it. Then you now go to the next most dilutive. And which one was the next most dilutive one? Out of the three potential? I think it was convertible preference. Yes, that convertible debenture, convertible debenture was the next most dilutive. So you come and see your convertible debentures. Now we are seeing again, if the debenture holders had converted, our earnings would have increased by the debenture interest that would have been saved on conversion. And we have seen the amount was 700,000. So that becomes the incremental earnings. Okay. Then we saw that if they had converted, you as a company would have issued to them how many shares? What was the incremental number of shares? The incremental number of shares, yes, here it was 1 million. It was 1 million. So you come and increase the earnings by 1 million. So this will come to 10.7. This will now come to 32.50. Let's compute what we are calling the diluted EPS now. So this will come to what? Let's calculate it. That is 10,700. Divide that by 32.50. That gives me an EPS of 3.3 to 1 decimal point. Then you go to the next one, and of course now the last one is the convertible preference. Convertible preference. Where you come and again see by how much would the earnings have gone up. We have seen the earnings would have increased by how much? I think it was 1 million. If the preference, yes, if the preference shareholders had converted, we would have saved that dividend of 1 million. We would have saved that dividend of 1 million. So that becomes the incremental earnings, 1 million. Even the number of shares we sold would be increasing by 1 million. So this will be 11.7 million, and this will now be 42.50. That will be 42.50. So we need to calculate what would be the earnings per share. What would be the earnings per share? So we take that 11,700, we divide that now by 42.50, and that gives me 2.8. 2.8. That is what now becomes the EPS now. Listen now. Once you compute, listen now, once you compute those earnings per share, you now choose, listen, you now choose the lowest of all of them. You choose the lowest of all of them to represent your diluted earnings per share, to represent your diluted earnings per share. So in our case now, our diluted EPS, this company will disclose it to be, our company will disclose our diluted EPS to be 2.8. 2.8. You pick the lowest of all of them to become your diluted EPS, to become your diluted EPS, okay? Now, before we do an example, before we do another past paper question now, before we do a past paper question, let me explain. It is possible that when you put in the last one, that is the convertible preference. If you put in the last one, listen, I'm changing something. Suppose you had put in the last one, and you had put in the last one, and when you put in the last one, for purpose of illustration, you got something like 3.8. I am assuming you took 11.7, you divided by 42.50, I'm assuming you got 3.8. Listen, we have said you would still choose the lowest to become your diluted, which in our case now would be what? Which in our case now would be what? Would be 3.3, the lowest in sound. Good. Now listen. But here, listen to this now. But here is a potential ordinary share called convertible preference, which instead of diluting the EPS, it has made the EPS to increase from 3.3 to 3.8. Listen, when I was putting the others were diluting. From 5, we went to 4.4. We diluted it. From 4.4, we diluted it to 3.3. But when we put in the convertible preference, we now realize that this convertible preference is making the earnings per share to increase instead of reducing. Listen. So if a potential ordinary share has that kind of a behavior, then we say, listen, we say that that potential ordinary share is considered to be anti. We normally say it is considered to be anti-dilutive. Anti-dilutive. So you may be told to calculate the diluted earnings per share. That is the question. Number A, they told you to compute the basic. Number 2, they told you to compute the diluted. Then number 3, they asked you to identify any anti-dilutive potential ordinary share. So if they asked you to identify any anti-dilutive potential ordinary share, then you would disclose it to be the convertible preference shares. You would disclose it to be the convertible, because it's not diluting. Instead, it's making the earnings per share to increase. So an anti-dilutive potential, listen, an anti-dilutive potential ordinary share is one that makes the earnings per share to increase instead of reducing. So that kind of a potential ordinary share, we refer to it as an anti-dilutive potential ordinary share. Okay? Now, listen again. before again we do another example, your company, listen, your company had the following income statement. Profit after tax, 10 million. No, 9 million. Then you have profit from what we call discontinued operation, 1 million. That gave you 10 million. Then you have dividends, ordinary dividends, maybe 3 million. Then you got a retained profit of 7 million. For now, I am assuming, listen, for now, I am assuming the company does not have preference dividends or preference shares. They only had ordinary. This is 1 million. Okay, now listen. So if you are given this as the income statement, and you are told to compute the basic EPS for this company, you will say how much are the earnings attributable to the ordinary shareholders. We know the earnings attributable to the ordinary shareholders would be the profit after tax and you less preference dividends. Listen, this company had a discontinued operation. Listen, in other words, they had either a branch or maybe another subsidiary which they discontinued this year. Listen, if a company has a discontinued operation, that means they discontinued one of their operations this year. Listen, from that discontinued operation, we as a company, we made a profit of not 1 million. 9 million is the profit after tax from continuing operations. We call it profit from continuing operations. Those operations that you still are continuing with, they gave you a profit after tax of 9 million. But this year, you discontinued one of your operations, either a branch, whatever it is, or a subsidiary, you discontinued it. But before you discontinued it, it gave you a profit of 1 million. So the true profit of your company this particular year is 10 million. That is the true profit earned. So when you are computing the basic earnings per share, I'll take the 10 million earnings that are attributable to the ordinary shareholders. I divide that by the number of shares, weighted average number of shares, 2 million. And that will give me 5 shillings. Now listen carefully now. For the same company, if the question tells you to compute the diluted earnings per share, listen now, to compute the diluted EPS for this company, when they had these several potential ordinary shares, maybe convertible preference, convertible debentures, and maybe the stock option, to compute, listen now, to compute the diluted earnings per share, listen, remember, diluted earnings per share is that earnings per share that is projected will be the EPS of the future. Don't forget. Why? Because by the end of the year, your company had a convertible preference. We are saying if they convert, they have not done it, but if they convert, what would be our earnings per share in the future? If the debenture holders converted their debentures into ordinary, what would be the earnings per share in the future? So when you are computing diluted earnings per share, listen, you are trying to project what would be the EPS if these guys had converted, if these guys had exercised, if these guys had converted the preference shareholders, which they had not done. Listen. So if your company has a discontinued operation, it is obvious that they are not going to be earning from that operation in the future. They have discontinued one of their branches, or they have discontinued one of their subsidiaries, whatever it is. So to try and listen now, to try and project the EPS of the future, now listen, you don't use to try and project the EPS of the future, which is what we are calling the diluted EPS. To now compute the diluted EPS, we only use the earnings attributable to the ordinary shareholders, listen, from continuing operations only. From continuing operations only. Why? Because we are trying to project the future EPS. But your company this year made a profit of 1 million from an operation that they discontinued this year. From an operation that they discontinued this year, whichever the operation. So in the future, are we going to expect to continue earning from that operation? No. So when I'm trying to compute the projected EPS of the future, which is what we are calling the diluted EPS, then I am saying, then do not use the earnings that have been earned from the discontinued operation. No, you only use the earnings from those operations that we are projecting will continue giving us income. Those are projects that will continue giving us income. Those are the ones now you use them to try and to project the earnings. So when you are computing the diluted EPS, listen, and your company has a discontinued operation, not all questions do give you discontinued, no, but one or two questions might tell you the profit of 10 million included 1 million shillings profit from a discontinued operation. Then you are told to compute number A, basic EPS, number B, diluted earnings per share. I have told you, for basic EPS, use the earnings from both the continuing and discontinued. Why? Because that's what you have actually earned this year. But when you are trying to compute the projected EPS, which is what we are calling the diluted EPS, now you use only the earnings attributable to the ordinary shareholders, from continuing operations only, which in our case will be 9 million, Then you divide that by the number of shares, 2 million. That means it will be whatever it will give you. That's what we are saying. Now listen. Meaning, when you come to this table, you are given the other income statement. Which is what I've given you down there. Now that we are computing diluted EPS now that we are trying to compute the diluted, it's true, for basic EPS, we use 10. But now our 10 million includes profit from discontinued. And we are trying to calculate the diluted EPS now. And we are trying to calculate the diluted earnings per share. So we are now saying, to calculate that diluted earnings per share, this time, listen carefully, this time you will now use not 10 million here to compute in the table. To compute the diluted earnings per share, you don't use the 10 million that you use for basic. No, this time utatumia 9 million. But your number of shares have not changed. It's still 2 million. But for purpose of dilution, utatumia the earnings attributable to ordinary shareholders from continuing operations only. That means you exclude profit from discontinued operations. You exclude profit from discontinued operation. That's what I'm trying to say. So that is important. That when the question is asking you number A, basic EPS, how much was the earnings attributable to the ordinary? 10 million. So 10 million, you divide by the number of shares, 2 million. That is 5 shillings. Basic. But I'm saying, for the same company, when they ask you to compute diluted, you must have computed the incremental EPS for all the potential, ordinary, whatever. Then you ranked them. Now you prepared this table. When you are coming to prepare this table now, so that you compute the diluted, now we are saying, for purpose of dilution, don't use the 10 that you use for basic. Now use how much? Use the 9, which is the earnings attributable to ordinary shareholders from continuing operations only. You exclude. Then you divide by 2 million number of shares. That will give you EPS of 4. Then you go on now diluting it. You go on diluting it. Go on diluting it until you get the last one. Then you choose the lowest. Then you choose the lowest. Are we together now? Are we together so far? I hope yes. I hope we are together now. Okay. So I want us to do now a past paper question. Now I want us to do a past paper question from that. Now I want us to do a past paper question from that. So let me project a question which was done. Let me project a question which was done on now in December 2017. December 2017. I am trying to project a question that was done in December 2017. That was the question that was done in December 2017. It was question number 4B. It was question number 4B. December 2017. It was question 4B. That was the December 2017 question number 4B. So I want to read it. I want to read it. I want to read it. That was question number 4B. So let me read it. That was question number 4B. I want to read it. Okay. It says, the following relates to Sugar Serve Limited for the year ended 31st of May 2016. You are given the net profit of the company for the period attributable to ordinary preference shareholders and ordinary shareholders as 14.6 million. That's the profit attributable to both the ordinary and preference 16 are 14.6 million. Number 2, information on the ordinary shares was as follows. Ordinary shares of shillings 10 each in issue on 1st of June, 2015. Don't forget, up there we have been told the year is ending on 31st May 2016. Okay. Now they are saying on 1st June 2015, there were 6 million ordinary. Number 2, ordinary shares issued, still under number 2, but bullet number 2, ordinary shares issued on 1st September 2015 at full market price. That is 1.2 million. Then it goes on to say the average market price per share, the average market price for the shares for the year ended 31st of May 2016 was 100 shillings. And the closing price of the shares as at 31st of May 2016 was 110. On 1st January 2016, 300,000 partly paid ordinary shares of shillings 10 were issued. They were paid or they were issued at 80 shillings per share with shillings 40 payable on 1st January 2016 and shillings 40 payable on 1st January 2017. Dividend participation was at 50% until fully paid. That's number 2. Number 3. Number 3, it says convertible, number 3, convertible loan stock of shillings 20 million at an interest of 5% was issued or at par on 1st April 2015. Half of the year's interest was payable on 30th September and 31st of March each year. Each shillings 10,000, each shillings 1,000 of the loan stock was convertible at the holder's option into 300 ordinary shares at any time. For each, I'm repeating there, for each 1,000 shillings of the loan stock was convertible at the holder's option into 300 ordinary shares at any time. Shillings 5 million of the loan stock was converted into ordinary shares on 1st April 2016 when the market price of the share was 100 shillings per share. When the market price was 100 shillings per share. That's number 3. Number 4. 1 million shillings, 1 million convertible preference shares of shillings 10 each were issued in the year ended 31st of May 2012. Dividends were to be paid half yearly on 30th November and 31st of May at the rate of 6% per annum. The preference shares were convertible into ordinary shares at the option of the preference shareholders on the basis of 2 ordinary shares for each preference shares issued. Holders of shillings 600,000 preference shares converted them into ordinary shares on 1st of December 2015. Number 5, corporation tax rate or corporate tax rate was 30% required. A, basic earnings per share for 2016, and number B, they are asking you down there to compute the diluted earnings per share for 2016. They are asking you to compute the diluted earnings per share for 2016. Okay, so let's start now. Listen carefully now. So for this question, listen. For this question, there are several things that took place in the year that affected the number. We started with the year with 2 million shares, I think so. No, 6 million. During the year somewhere, some shares were issued at 1.2, if you remember. At the start, at the start of the question, we were told the company, that was note number 2. We were told, yes, we started with 6 million, but on 1st of September 2015, I hope you can see, some 1.2 million shares were issued at full market price. Listen. So what you will do, listen, to compute the weighted average number of shares, you will have to go through the whole question and find out what is it that took place during the year and affects the number of shares. What is it that took place during the year and affects the number of shares? Listen. For example, we started with 6 million. Then somewhere we issued 1 million, 1.2 million at full market price. So you obviously know the rule for shares issued at full market price. What was the rule? What was the rule? What did we say when we were discussing the basic EPS? What was the rule when shares are issued at full market price? What was the rule that we said should be followed when shares are issued at full market price? We said when shares are issued at full market price and they are fully paid, they must be weighted on time basis. So this time, to the 6 million, you will not just add 1.2. We said they must be weighted. We shall discuss. Then we were saying, another thing that could have taken place during the year, for example, is bonus. Maybe another 1 million shares were issued as bonus. What's the rule for bonus? When shares are issued as bonus, what do you know? When shares are issued as bonus, what do you know? We said, when shares are issued as bonus, are they weighted? No, they are not weighted. Why? Because we said they are assumed to be issued when? At the beginning of the year. Then maybe another time, shares were issued and they were issued as partly paid. 1 million shares. What did we say? When shares are issued and they are partly paid? What did we say when shares are issued and they are partly paid? What did we say when shares are issued and they are partly paid? What did we say when shares are issued and they are partly paid? We said when shares are issued and they are partly paid, to compute the basic EPS, use only the shares to the extent that they have been fully paid. Only to the extent that they are fully paid. Good. Another time during the year, within the same 1 year, maybe shares were issued on conversion. We shall find out from the question, but we are just trying to remind ourselves the rules. Maybe some shares were issued on conversion. Maybe your company issued 1 million shares on conversion of debentures or preference into ordinary. What did we say? What was the rule for conversion? When shares are issued on conversion, what was the rule that time? Obvious, we said, they must be weighted again. When shares are issued on conversion, they must be weighted on time basis. Maybe again during the year, another 1 million shares were issued as a result of a stock option. What was the concern that time? When shares were issued as a result of a stock option, what did we say? When shares are issued as a result of a stock option, what did we say? We said when shares are issued as a result of a stock option, then some of those shares are deemed to be issued at full market price and some of them are deemed to be issued as bonus. So we said you will separate. Once you separate the ones issued at full market price and the ones issued as bonus, we went further and said those issued at full market price must be weighted. Those issued as bonus are never weighted. Are you remembering? I hope so. Good. That was our lesson number 1 when we were discussing all this. Then what again? What if again, maybe during the year some shares were issued as a result of a rights issue? When shares are issued, maybe 1 million shares were issued as a result of a rights issue. What was the concern that time? What did we say? What did we say? We said when shares are issued as a result of a rights issue, again, some of those shares are deemed to be issued at full market price and some are deemed to be issued as what? As bonus. I hope you still remember. Some of the shares are deemed to be issued at full market price and some are deemed to be issued as what? As bonus. And then we said you must separate them again. But I do hope you still remember, we said, how do you separate them? We said you don't separate the 1 million shares into those two components the way you separated the ones for stock options. No. You remember, for stock options, we were taking the amount received from the stock option, we were dividing that by the market price per share. That was giving you number of shares deemed to be issued at full market price for stock option. But when it's a rights issue, which we were saying still is a privilege to the existing shareholders to buy shares at a price below the market price, to Kasema, for you to determine how many shares are issued at, how many shares are considered to be issued at full market price, when it's a rights issue, we said you start by first calculating a price we called what? We said you start by calculating a price we were calling what? We were calling a theoretical X right price. I hope you still remember. You compute a price called theoretical X right price. How are we getting that theoretical? I hope you remember. We were taking the market capitalization of the company after the rights issue by dividing that by the number of shares after the rights issue. So for this particular question that we want to do for December 2017, there were several things that took place in the year which affected the number of shares. So we need to go through one by one and find out, as per that particular item, what is the rule for that item? What is the rule for that item? If it is shares that were issued at full market price, they must be weighted on time basis. If they are bonus, not weighted. If they are partly paid, only consider them to the extent that they are fully paid. If the shares were issued on conversion, only consider them, the only key point we said there is that they must be weighted on time basis. If it's a stock option, then we said separate between the ones issued as full market price and the ones issued as bonus. Those issued at full market price are not weighted. Those issued as bonus are never weighted. Same for the rights issue. Split the shares again between those issued at full market price, which must be weighted, and those issued as bonus and they are not weighted. That's what we are saying. So for now, we want to go through the question which we have gone through, and now we want to use it now to compute. Now we want to use it to compute what we are calling the weighted average number of shares. So Let's put down our workings now. Let's put down our workings for this particular question. We are told by the question that we began the year with how many shares? Note number two, I hope you can see it there. It said we began the year with 6 million shares. Okay, so let's put down somewhere, andika determination of the weighted average number of shares. Determination of the weighted average number of shares. And our year began on 1st of June 2015. So we come and say weighted average number of shares. We are computing the weighted average number of ordinary shares. We come and say 1st of June 2015, balance brought down. We began the year with 6 million. That one you can push it to the extreme. Then from the same note number two, number one was just information. I hope you remember. Number one was just information about the profit attributable to both preference and ordinary. Then number two, we are given the number of shares by the beginning. Then the same number two, bullet 2 says, ordinary shares issued on 1st September 2015 at full market price 1.2. So on 1st September, this is 1st September 2015, issue at full market price. Issue at full market price. We issued 1.2 million shares, and we have said, and we know the rule, when shares are issued at full market price, they must be weighted on time basis. Let's confirm, by the way, I was almost assuming. These guys brought in the money in September. Our year began in June. This is June. This is June. That is June. So we did not have their money in June, July, and August. Listen, we did not have the money of these guys who are buying at full market price. We did not have their money in June, July, and August. So they brought in the money on 1st September. So it is obvious their money financed me for only 9 months. So we take 9/12 of the 1.2. That means they must be weighted. Now somebody calculate. It's obvious 12 and 12 will go. That will leave me with 900,000. That's what you push to the extreme, 900,000. Then we go back to the question, find out what came next. After note number 2, still on the same note 2, still on the same note number 2, they are saying, still on the same note number 2, they are saying the average market price the average market price of the company shares for the year ended at 1st of May 2016 was 100, the average market price. And the closing market price was 110. On 1st January, that's where we are now, on 1st January 2016, 300,000 partly paid shares of shillings 10 each were issued. They were issued at 80 shillings per share, with 40 shillings payable on 1st January 2016 and the 40 shillings payable on 1st January 2017. Dividend participation was 50% until fully paid. Listen, we say when shares are issued and they are partly paid, I hope you still remember the rule. When shares are issued and they are partly paid, we said only consider them to the extent that they are fully paid. Only to the extent that they are fully paid. In other words, only to the extent that they will participate in dividend. This question has even reminded you, that they are participating in dividend only 50%. We issued the shares at 80, only 40 have paid. So only 50% of the amount has been paid. So we shall participate. And we issued how many shares and when? Let's go back. That was when? Note number 2 on 1st January. On 1st January 2016. 300,000 at 80 when they paid me 40. Sour. So let's put it on 1st January 2016. 1st January 2016. This is 1st January. 1st January 2016. Partly paid shares. So we consider them only to the extent that they are fully paid. We issued 300. So they brought in how much? 300 times 40. Because they paid us 40. But one share had a market price of what? 80. Listen, 80. So if they paid 40 on their 300,000 shares, then they paid me around how much? Is it 12 million? Yes. But the market price per share was 80. The market price per share was 80. So, listen now. So, on 1st January, we issued 300,000. We issued 300,000 at 40 shillings. No, at 80, but they paid us 40. So, to the extent that they are fully paid, it is 50%. But don't forget again, listen, don't forget again, we said, these shares which we issued on 1st January, the money that they paid us, which is 12 million, that amount again did not finance us for the full year. The money came in January 2016. When is our year ending? Our year is ending on 31st May 2016. So that automatically means that their money, which came in January, only financed me for 5 months, because they brought in the money in January, that 12 million, and we are closing the year in May 2016, 31st of May. That means the money only financed me for 5 months. So you remember to multiply this by 5 over 12. Otherwise, if the money came in the beginning of the year, you just have to determine the wares issued at full market price. That would have been 300 times 40 times divided by 50. By 80, sorry. But now, because the money came in January, it never financed me for the full year. So somebody with a calculator, give us how many shares now are going to be used for purpose of earnings. Otherwise, I've said, if the money came in January at the beginning of the year, only 150 would have participated, which is half of the 300. But now, because the money did not come in at the beginning, it came in between the year, I can't give you earnings again for the whole year when your money did not finance me for the full year. Your money financed me for only 5 months. So I give you earnings for only 5 months. So what are you getting? I am getting something like 62,500. 62,500. That is it. So we are through with our note number 2 now. We are through with our note number 2. So let's go to the note number next. I think that's note number 2. Imeisha. Number 3. Number 3 says, convertible loan stock of shillings 20, convertible loan stock of shillings 20 million at an interest rate of 5% was issued at per on 1st of April 2015. Half of the interest was payable on 30th September and 31st of March. Each shillings 1,000 of the loan stock was convertible at the holder's option into 300 ordinary shares at any time. Shillings 5 million of the loan stock was converted at the holders, was converted into ordinary shares on 1st of April 2016, when the market price was 100. That doesn't make a difference. So we are told, out of the 20 million, 5 million converted, 5 million converted. For each 1,000 shillings, you get how many ordinary? For each 1,000 shillings, you get how many ordinary? You get how many ordinary? 300. Sawa. So let's come and say 1st April. That's when they converted. We come and say 1st April 2016. Issue on conversion. Issue on conversion of what? What is it that converted? Let's first loan stock. Issue on conversion of the loan stock. Loan stock. So let's compute the number of shares now. Let's compute the number of shares. For every 1,000 shillings, you get 300 ordinary. That was the agreement. What about for the shillings 5 million that converted? What about for the shillings 5 million that converted? This will be 5 million, multiply that by 300, divide that by 1,000. Let me put it this way. Let me put it this way so that I have enough space. What about 5M so that I have enough space? So it will be 5M times 300. Divide that by 1,000. Okay? But don't forget, again, the rule says when shares are issued on conversion, what is the rule? When shares are issued on conversion, what is the rule? The rule says they must be weighted. So if they were issued on 1st of April 2016, these guys who converted their loan stock into ordinary were my shareholders for only how long? They were my shareholders for April and May, and the year ended. They were only my shareholders for April and May, and the year ended. Those are for 2 months. So multiply that by 2 over 12. When shares are issued on conversion, the key point we said is that they must be weighted on conversion. Okay? That's what we have done. So give me the number. Do that calculation. For every 1,000, you get 300. What about for the shillings 5 million? It will be 5 million times 300, divide by 1,000. But because they were shareholders for only 2 months, those shares must be weighted. Those shares must be weighted on time basis, because that's the rule. What are you getting? Okay. I am getting an amount of 250,000. Okay. 250,000. If you are getting the same, that's okay. We now move on to the last one. I think that was note number last. Note number last, which is number 4. We can read it. Note number 4 says, shillings 1 million of the convertible preference shares, shillings 1 million of the convertible preference shares, shillings 1 million of the convertible preference shares of shillings 10 each were issued in the year ended 31st May 2012, many years ago. Remember, we are in 2016. Then wanasema dividends were to be paid half yearly on 30th of November and 31st of May at the rate of 6% per annum. The preference shares were convertible into ordinary shares at the holder's option of the preference shareholders on the basis of 2 ordinary shares for each preference share, Holders of shilling 600,000, preference shareholders, holders of shilling 600,000 preference shares converted them into ordinary shares on 1st of December. So we come to 1st of December now. We now come to 1st of December. So we come and see 1st December 2016. Issue on conversion. Issue on conversion of preference shares. Go back, get the basis of conversion. Go back, get the basis of conversion. What are they saying? I think they said for every, how many you get what? Let's get it. Wamesema, the last sentence, the preference shares were convertible into ordinary shares, at the option of the preference shareholders on the basis of 2 shares for each preference share. Remember it said at the start, shillings 1 million convertible debentures preference shares of shillings 10 each were issued many years. That is in 2012. Then they are now telling us, forget about the dividends were paid. That doesn't make a difference. We just need to know what they had at the beginning, how much is converting. Wamesema, the dividend was 6%, okay? Then wasema preference shares were converted into ordinary at the option of the preference shareholders on the basis of 2 ordinary for each preference share. Holders of 600,000 shillings, holders of 600,000 shillings preference shares converted. So sawa. So for every what? For every 1 preference shares you have, you preference shareholder, for every 1, you can get how many ordinary? According to that note, for every 1 preference shares you have, you as preference shareholders, you can get how many ordinary? They are saying on the basis of 2 ordinary for each preference share. So you, for each preference share, for every 1 preference share, you can get 2 ordinary. You can get 2 ordinary. Then we say, what about what? We go back to the question. We say, what about what? We shall say, what about what? What about what? We shall say, what about what? What about? I hope you are careful there. Some will say, what about 600? That is wrong. Don't say, what about 600? I hope you are reading carefully that note. Listen. This is not like note number. This is not like note number 3. Listen. Note number 3 said, I hope you are listening. Note number 3 said, for every 1,000 shillings of the loan stock, you get 300 ordinary. Then we said, what about shillings 5 million? Because we were told shillings 5 million converted. I hope you are following. So in note 3, they had said, for every 1,000, I hope you can see here on 1st April, for every 1,000 shillings of the loan stock, they could get 3 ordinary, 300 ordinary. What about shillings 5 million? Listen. So that time, the basis was, the base of conversion was on the basis of shillings. For every 1,000 shillings, you get 300. What about 5 million shillings, which converted? But when you come to 1st December, when preference shares are converting, the basis is, I hope you are following, the basis is for every 1 preference, you could get 2 ordinary. What about? Listen, now you can't say, listen, you can't say, what about shillings 600? That was a trick the examiner wanted to get you on. That was a trick the examiner wanted you to get on. Some students will just rush and pick 600, which is wrong. Remember, 600 is the shillings. But therefore, if true 600 shillings converted, you need to know how many shares converted. We were told by note number 4 that 1 preference share had a par value of how much? 1 preference share had a par value of 10. So if 600,000 shillings converted, how many shares are those that converted? Remember, we began with 1 million shillings, but now we are converting in the basis, on the basis of numbers, not shillings, numbers. But the trick here was, what was the par value per share? The par value per share was 10. So out of 600,000, how many are those? That comes to 60,000. 600,000 divided by the par value per share, 10 bob, that comes to 6. That is what converted. Don't confuse. That was a trick the examiner wanted to catch you on. So you will come and say, it will be 60,000 times 2 divided by 1. Don't forget again. The rule says, when shares are issued on conversion, they must be done what? They must be weighted on what? On time basis. They must be weighted on time basis. Just like the 1st April convertible loan stock. This is now preference. Who are converting? Again, they must be weighted on time basis. For how many months? These guys converted on 1st December 2016. So they are my shareholder in December. And how many more months? How many more months for 2017? Because we are doing our financial statements up to when? We are doing our financial statements up to when? Up to Wait. They converted on 1st December. Sorry. Look at the question down there. They converted on 1st December 2015, not 16, sorry. 2015, not 16, sorry. 2015. So if they converted in 2015, 1st December, they were my shareholders for that 1 month of 2015 and another 6 months, no, another 5 for 2016. Why? Because we are closing the year in May 31st, 2016. We are closing on 31st May 2016. So they were my shareholders for December 2015 plus another 5 months of 2016. So they were my shareholders for only 6 months. So multiply that by 6 over 12. Multiply that by 6 over 12. Somebody with a calculator now. What becomes the number of shares for purpose of weighted average number of shares? How much are you getting? 60,000 times 2 divided by 1, multiply that by 6 over 12. That is 120 in bracket times 6 over 12. That's again about 60,000. Okay. So according to this question, we have used all the items that took place in the current year. Number 5 is just information you can see. So we are through with the items now. So somebody now can add for us the total now. Add for us the total so that we call it the weighted average number of shares. The weighted average number of shares. Add from me from the top. We started with 6 million plus 900 plus 62,500 plus 250,000 plus the last one of 60. What do you get as the weighted average number of shares? Okay. I am getting an amount of 7,272,500. I hope I'm right. 2,272,500. That is it. Listen. So now we are through. Now we are through with part A. No, with the weighted average. But don't forget now, we want to compute the basic EPS now. To get the basic EPS, you take the earnings attributable to the ordinary shareholders, you minus the preference dividends. You take the net profit after tax, you minus preference dividends. That's what you get as the earnings. So andika somewhere, next writing, andika determination of the earnings. Determination of the earnings attributable determination of the earnings attributable to ordinary shareholders. Somewhere you remember we were told by note number 1, if I may take you back. Let's go and see that note number 1. They say the net profit of the company attributable to the preference and ordinary was 14.6 million. Good. So that is what you can call net profit after tax. 14.6 million. $14.6 million. Then we now less what is attributable to the preference, because we are computing the basic earnings per share, and so we want the earnings attributable to ordinary shareholders. But this 14.6 is for both preference and ordinary. And you know, preference shareholders normally get a fixed return every year. So what is it that we paid them as dividend? That will be their earnings. So we come and less preference dividends. So we go back to the question, find out what is the rate of dividends and how much was the dividend. That information was given to us under note number 4. That information was given to us under note number 4. Listen. Shillings 1 million, I'm reading note number 4, shillings 1 million of the convertible debentures, a convertible preference of shillings 10 each, were issued in 2012. Dividends are paid half yearly, whatever, at 6%. Preference shares were convertible into ordinary, blah, 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 whatever. Then you are told holders of shilling 600,000 converted them into ordinary on 1st December. Listen. So we began the year, I want you to listen carefully. We began the year with preference shares amounting to 1 million. So it is obvious we paid on that dividend on 1 million, we paid dividend up to some point in time. Then after that point in time, which is 1st December, we never continued paying dividends on 1 million shillings. Why? Because some of them converted and they went and became ordinary. So we can't pay them again preference dividends. No. So we are saying, listen carefully now. I am saying, let me illustrate. We began the year with 1 million preference shares, shillings, 1 million. After some time, some of the preference shareholders converted into ordinary. So we continued with the balance as ordinary after some disappeared. Out of the 1 million, 600,000 converted. So if this is 1 million, 0.6 converted. So it is obvious we were left with 0.4 to continue paying as dividend on dividend for dividend. So if 1 million was there by the beginning and the rate is 6%, we are asking ourselves, for how long did we pay on preference dividends for on 1 million? Then come 1st December 2015, 600 disappeared, no longer remaining as preference. So we only remained with 400,000 out of their million. Then we paid them another dividend for another period. If they converted on 1st December, we saw this was 6 months, I hope you remember, which means we have another 6 months. So from the beginning of the year up to December 1st, 2015, those were 6 months. For 6 months, we paid dividend on 1 million. I hope you are following. We paid dividend on 1 million. After December 2015, 600,000 of the preference shares never continued being preference shares. They became ordinary. So we only remained with 400 as preference. That from there again, we continued paying on that amount. So we are calculating the dividend on 1 million for 6 months and on 400 for another 6 months. Good. So let's calculate it now. What is the total? So we are getting this way. We are saying 6% of 1M times 6/12 plus, after 6 months, this is 1M. After 6 months, now we remain with 400, which is 0.6, 0.4. So that will be 6% of 0.4M for another 6 months. That's what we are saying. So this is 1M, 6% of 1M. Then I've said after 6 months, 600 disappeared, became ordinary. So we continued paying on 400 for another 6 months. So get me the total dividends we paid for those 6 months, for the whole year. Get me the dividend. What are you getting? Take 6% of 1M times 6/12 plus 6% of 400,000 times 6/12. What are you getting? Yes, how much? Okay, I'm getting 42,000. So we minus that 42,000. So we minus 42,000. What do you get? As now what we can call net profit after tax and preference dividends. What is it that we can call as net profit after tax and preference dividends? We minus that. That looks like 0, 0, 0. I am subtracting. That is 8, 5. That is what? 5, 4, 1. I hope so. 14,500,000 558. I think I'm right. Good. Now we know the earnings. Now we know the weighted average number of shares. Let's compute the basic now. So we come and see a basic EPS now. Would be 14,558,000. We divide by the weighted average. What did we get as the weighted average number of shares? Let's go back. 7,272,500. Good. We got it as 7,272,500. Somebody calculate it. What becomes now the basic EPS now? Before we go to the last part, which is to compute what we are calling the diluted EPS now. What are you getting? Okay, I am getting something like 2.002. 2.002. So we are through with part A of that question. We are through with part A of that question, which required us to calculate what we were calling the diluted the basic earnings per share. So let's do part B of the question now. Let's do part B of the question, which is asking us to calculate what we are calling the diluted. Listen. As I've already explained, we say to get the diluted earnings per share, go through the question and identify, listen, and identify the potential ordinary shares. What we were calling the dilutive factors. Once you identify them, I said, for each of them, calculate what we were calling the incremental earnings per share. Once you calculate the incremental earnings per share, for them, all of them, once you do for all of them, I said you rank them according to their degree of what? Dilution. Okay? I said starting with the most dilutive. Starting with the most dilutive. And I said the most dilutive being the one with the highest, the one with the lowest incremental earnings per share. That is the most dilutive. And you end with the least dilutive. The least dilutive, I said, is the one with the highest incremental earnings per share. Okay? Goodness for this question, there was no discontinued operation. But I hope you remember, we said if there's a discontinued operation, you only use the earnings attributable to ordinary shareholders from continuing when you are computing diluted. But this question did not have any discontinued operations. So the same earnings we use for basic are the same ones we shall use for dilution. Okay? Because there was no discontinued operation. Okay? So write down somewhere, we are doing part 2 of the question now. Put down somewhere determination of the incremental earnings per share. You remember we had various columns. The first column was potential ordinary. Once you identified it, the next column we said was incremental what? EPS, incremental earnings, incremental earnings. This is incremental earnings. After that, we said you come to what we were calling incremental what? Incremental, let me put them in short so that I have enough space. Incremental number of shares. Then from there we said incremental what? EPS. Then finally we said you come and do the ranking. The ranking. So let's go one by one. Let's go one by one and pick each of the potential by the end of the year, a potential ordinary share, a potential, something that is likely to give the owners the opportunity to own shares. Number one, let's go through additional information, one, and after the other, we see whether there is anything potential. From note number 1, there is nothing potential there. From note number 1, I hope you are noticing there is nothing potential there. That's all. Number 2, we began with 6 million ordinary shares. That's not a potential. We issued another 1.2 million shares. That's not potential. On 1st of September, no. But note number 2, the second part said, the market price per share for the year ended 31st of May 2016 was 100 shillings, the average market price. The closing market price was 110. On 1st of January 2016, 300,000 partly paid shares were issued. They were issued at 80 with 40 shillings payable on 1st January 2016, and the 40 payable on 1st January 2017. Remember, we are closing our business on 31st May 2016. On 31st May 2016. So the other 40 will not be paid this year. They paid 40 on 1st January 2016. The other 40 they are saying will be paid on 1st January 2017. That's not in the current year. It will be paid in the next year. So it means by the end of this year, listen, it means by the end of this year, our company still has some partly paid shares. Some partly paid shares. Some partly paid shares. Listen, we say partly paid shares are considered to be dilutive. Remember, we issued 1 share at 80 bob. Though they only paid me 40 out of this, but we issued them at 80 bob. We said partly paid shares can be considered to be dilutive only when one condition is met. What was that condition? Only when one condition is met. What was that condition? Only when one condition is met. What was that condition? When, listen, when there is an increase in the market price per share since the date of the issue. If there is an increase in the market price per share since the date of the issue. We issue to you shares at 80 bob. You have only paid us 40. You are supposed to bring the other 40 any other time. But come the end of the year, you have not brought in 40. But you could bring it any time. Now listen. So we say, listen, we say when shares are issued, we issued how many shares? 300,000. Don't try it fast. I am trying to explain. Don't try it. We issued 300,000 and they were 50% paid up. In other words, we issued 300 at 40 bob when the market price was 80. So to what extent were they fully paid? Only 150. Nisawa, half, 150. So we were arguing this way. I hope you are listening. We were arguing this way. On the day they paid me the 40, I issued to them 150. So they paid me 12 million. 40 per share, but 12 million in total. I think it's 12 million. I think so, yes. So that day when they paid me 12 million, I gave them 150,000 shares to the extent that they are fully paid. To the extent that they are fully paid. Listen carefully. So the moment they brought in the 12 million, I gave them 150,000 shares. They will bring the balance of the 12 million in future, and I'll give them the balance of their shares. The balance of their shares to the extent that they are fully paid. I hope you still remember, which is how much? 150. Listen. But they are going to bring in this 12 million when the market price of the shares has already gone up. When the market price is no longer 80. It's how much? We were told by that note number 2, the average market price for the year was 100 and the closing market price was 110. So the question again wanted to confuse you so that you ask yourself, how much should I use? Should I use 110 or 100? Listen, the moment we issued to them, the shares were selling at 80. They were supposed to pay me the balance of the 40 anytime, but they never paid us. Had they paid us anytime, we are told by the question, the average market price per share during the year was 100. So you use 100, not the closing market price, the average for the year. If the market price has increased since the date of the issue, and the average increase is 100, not 110. 110 is at the end. But we are saying, had the market price increased since the date of the issue? Yes. So which to is how much? To an average of 100. Listen. So if they bring in the 12 million, if they bring in the 12 million, at a time when the market price is how much? 100 now, average. It means their 12 million will be enough to buy, not 150, but it will be enough to buy only 120. But we agreed, the moment they will bring in the balance of the 12 million, I am going to give them the balance of their shares. Remember, we started by issuing 300. Because they had paid half of the money, only half of the shares are participating in dividend. The question even told us they were participating in dividend only 50%. That one, the question reminded you, which I told you, it has helped you. But now we are saying only 150 are currently participating in dividend. The moment you will bring in the balance in future, I'll give you the other balance of 150. But suppose you bring in at a time when the 12 million, suppose you bring in the other balance of 12 million at a time when the market price has increased to 100. That means your 12 million will not be enough to buy 150, it will be enough to buy 120. But we have agreed, the moment you will bring in the 12 million, I am not going to give you 120. I am not going to give you 120 as per the market requirement. I'm supposed to give you the balance of your shares, which is 150. So we are saying, and we said, it is like, out of the 150 I'm going to issue you in future, out of them, it is like 30 are going to be given for free. It is like 30 are going to be given for free. And we said, when shares are issued and they are partly paid for purpose of dilution, it is only the bonus. It is only the bonus share element in the partly paid which are going to be considered to be dilutive. Sour. Good. I hope you remember the rules. We have just talked about the dilutive factors. And we have said, for partly paid, we said it is only the bonus element in the partly paid that are going to be considered dilutive. So far, I've issued you 150. Those ones, you are eating dividends on them. The moment you will pay me as a company, the other 12 million, I'll give you the other 150. Fine. But suppose you bring in the 12 million at a time when the market price is 100, not 80. Then it means your 12 million should be enough to buy only 120,000 shares. But I'm not going to give you 120. I'm going to give you 150. So it's like out of 150, I am going to give you another 30 for free. Those 30 are the ones we are saying will be considered to be dilutive, And those are the ones now we are saying will be used for purpose of dilution. Sour. Good. So let's go back to our table here now. Good. So we come to number 1, and our first potential ordinary share is what we are calling partly paid shares. We come and ask ourselves, what effect does it have on the earnings? I do hope you remember. We said, even if they bring in the other 12 million in the future, our earnings, we said, will not change. Our earnings, we said, will not change. It will still remain whatever it was, which is that 14.6 million. I hope you remember. So the effect on the earnings is nil. The effect on the earnings is nil. So you can write there nil. So under incremental earnings, put 0. Then we come and say number of shares as bonus. Number of shares as bonus shares. Don't forget, it is only the bonus that are considered to be dilutive. Only the bonus element that are considered to be dilutive. So out of the 150 I'm going to give you in future, how many of them are dilutive bonus element? Listen, so we are getting it by taking 150,000, which is the total balance I'll give you. Out of them, I remove which ones? I want to get the ones issued as bonus. So you will bring in the 12 million and I'll give you 150,000. But out of this 150, some are going to be deemed to be issued as bonus. I want to get them. So it's the same as taking this 150 and removing those which will be issued at full market price, which is what we are getting as how much? As 300,000. Remember, you will bring in 300,000 times 40. We shall divide that now by 100. You will bring in 12 million at a time when the market price is no longer 80, but a what? But 100. Good. Then we are saying this which is in bracket here is what I am calling at full market price. I hope you are following. At full market price. So it means therefore, out of 150, 120 are going to be given at full market price. So it leaves me with a balance of how much? Of 30 to be considered as bonus. So put that under incremental number of shares, 30. That is the incremental number of shares. So we are through with our first potential ordinary share by the name of partly paid, which we are saying when shares are partly paid, only consider them to the extent that they are fully paid, which we did, 150. Then we are saying for purpose of dilution, that was for basic, for purpose of dilution, only those that are considered to be the bonus element. So I gave you 150 when we were computing the basic. You will bring the balance, I'll give you another 150. But out of your 150 that I'm going to give you, how many are going to be given to you for free? Is you take the amount you will receive, you will bring in the future, divide by the average market price for the company's shares. That is 100. Good. So our incremental EPS, by the way, is how much? 0 divided by 30 is obviously an incremental earnings EPS of 0. Sour. Now we can go to the next potential. Let's check the next potential. That is not number 2. Number 3. Yes, number 3 has another one. Number 3 has another one. It says convertible loan stock of 20 million at an interest rate of 5% was issued at par on 1st April 2015. 1st April 2015 is the beginning of the year because our year is ending on 31st of May 2016. So if they were issued on 1st April 2015, that was the beginning of the year. Half of the year's interest is payable on 30th September and 31st of March. That doesn't matter. Each shillings 1,000 of the loan stock was convertible at the holder's option into 300 ordinary shares at any time. Shillings 5 million of the loan stock was converted into ordinary shares on 1st April 2016 when the market price was 100. Okay, now listen. We began the year with how much, Kwanzaa? 20 million. We began the year with 20 million. Listen, we began the year with 20 million. Don't write this. Let me first explain. Don't write this. We began the year with 20 million worth of loan stock. After some time, 5 million of that amount, wamesema, 5 million of that amount converted. So it is obvious again, we paid interest on 20 million for some period of time. Then after that, shillings 5 million of this loan stock converted their loan stock into ordinary. So we were left with another 15 to pay interest for another period. So we want to know, for how long did we pay interest on 20, and for another how long did we pay interest on 15? Don't forget, we said, if these debenture holders had converted, I would have saved interest. If they had converted, the moment I issued to them the debentures, had they converted this year, I would not have paid them interest. So that which we paid them this year, is what I would have saved, What is it? And again we said, I would have saved it net of tax. Net of what? Tax. So when did these other guys convert? They converted. Note number 3 says, they converted when? On 1st April 2016. That's when they converted here, on 1st April 2016. The year is ending on 31st May 2016. So it is obvious, listen, they converted, and we continued paying on 15 for the month of April and May only. Because if they converted on 1st April 2016, then we must have paid interest on 15 million, because 5 million converted, we must have paid interest on 15 million for the month of April and May. Then the year ended. So it also implies that on 20 million, we must have paid interest on how many months? 10. Because the other 2 months, we paid for on 15. So for 10 months, we paid interest on 20 million for 10 months. For another 2 months, we paid interest on 15. So cumulatively, what is it that we paid for the whole year? That which we paid for the whole year, we would have saved it. But would have saved it net of what? Net of tax. Good. So now let's go back to our table. So we are now saying the second potential ordinary share is what we are calling convertible loan stock. Then again, we ask ourselves, what effect does that have on the earnings? Had they converted, we would have saved interest. We can come and say, yeah, interest saved. Interest saved. How much? That's what we want to see. First, we know the rate of interest. Let's know the rate of interest. From note number 3, what was the rate of interest on the loan stock? 5%. Good. I can see it now. 5%. Good. So we come and say, what is 5% of 20M for 10 months plus? After 10 months, 5 converted, they went and became ordinary, so we were left with 15. At another 5% of 15M times another 6, no, times 2 over 12 for 2 months. That is what we paid. Listen, that's what we paid them. But we are saying we would have saved it. We would have saved it net of what? Net of tax. So maybe because of space, let me rub first, I squeeze it completely because of space. So we are saying it is 5%. No, yeah, 5%, sorry. Yes, 5%. 5% into 20M for 10 months plus 5% of 15 for another 2 months. That's what you paid. That's what you paid. But I would have saved it net of tax, which means I take 1 minus what is the tax rate? We were told the tax rate was what percentage? 30%. Good. So we multiply that by 1 minus 0.3. So calculate for me that. What becomes the incremental earnings? What becomes the incremental earnings? What becomes the incremental earnings? Do that calculation. What becomes the incremental earnings? Take 5% of 20 million times 10 over 12 plus 5% of 15 million times 2 over 12. Once you get all that, just multiply by 0.7. Just multiply by 0.7. Okay, I am getting an amount of 883. I hope I'm getting the same. 883. No, 833, sorry. 833. 833. Sour. 833, sorry. That's all for the incremental earnings. What about incremental number of shares? On the same, what is the incremental number of shares now? So we come and see a number of shares. I want you to listen carefully again. Listen. Let me first explain. Again, we began the year with 20 as convertible. After 10 months, we have said, listen, after 10 months, we have said 5 million went. So we continued with 15 million for another 2 months. Listen. So it is obvious, therefore, that 20 million loan stock remained convertible for 10 months. And another 15 million remained convertible for 2 months. Had these guys converted, we would have given them how many shares? The question told us, I hope you remember, for every 1,000 shillings of the loan stock, they could get 300 shares. Listen, for every 1,000, they could get 300 shares. What about 20 million that was convertible for 10 months? Plus, what about the 15 that was only convertible for 2 months? Listen. So we are saying, to get the incremental number of shares, utasema 20 million was convertible for 10 months. After 10 months, 5 million converted, became ordinary. So it's no longer convertible. Only 15 of the loan stock remained convertible for the rest of the year, which is how many months? 2 months. So for 10 months, 20 million was convertible. For another 2 months, 15 million was convertible. Yet the question says, for every 1,000 shillings, you get 300 ordinary shares. What about, listen, what about 20 million for 10 months plus another 15 million for 2 months? That's what I want to do. So I put it there now, this way. We now put it this way. We come and now say, number of shares. Listen, it will be for every 1,000 you get, for every 1,000 we were told you get 300. What about 20 million? What about 20 million? It will be 20M times 300. Divide that by 1,000. Follow. For how many months? For 10 months. That was potential for 10 months. Plus, after 10 months, 5 million converted. So we are remaining with 15. 15 remained potential for 2 months. For every 1,000 shillings, you get 300 ordinary. What about for 15 million? So it will be 15M times 300. 15M times 300. You divide that by 1,000. But again for them, for 2 months. So somebody calculate for me the incremental number of shares now. What becomes the incremental number of shares? For every 1,000 shillings you get 300 ordinary. What about 20 million that was potential for 10 months? After 10 months, 15 million remained convertible potential. For how long? For 2 months. So what about for those 2 months? On their 15 million. Then you add. What are you getting? Okay. I am getting an amount of 5 million. I hope I'm right. 5,750,000. 5,750,000. Now we know the incremental earnings are 670, 833. We now know the incremental number of shares. What becomes the incremental earnings per share? Let's calculate it. So I am taking 670,000, 833, divide that by 5,750,000. You get an incremental EPS of, on the column for incremental, worker 0 point, sorry, that is 0.12 to the nearest 2 decimal places, 0.12 under the column called incremental EPS. Kwa column ya incremental EPS, worker 0.12. That is all for note number 3. We go to the last one, I think. Yes, number 4. That's the last one. Number 4 again, we had a convertible preference, you remember? We began the year with 1 million shillings of the debentures, of the preference, sorry, of the preference. Then on the last part down there, we were told 600 converted on 1st December 2015. So we paid dividends on 1 million, you remember, for 6 months up to 1st December 2015. Then after December 2015, we saw, even when we were computing the earnings attributable to the ordinary, we saw after 6 months, 600 converted to kabaki na 400. So tukawalipa on 400 for another 6 months. So what would be the incremental earnings? So let's put down. It's the same working we did when we were computing the earnings here. It is the same workings here. The same workings here. This one. Still the same. Because 1 million we paid for 6 months and another 400 we paid for another 6 months, which came to 4.2. No, 42,000. I can see there. That's becoming our incremental. So let's go there and now pick it. So we come to number 3, convertible preference. Convertible preference. We come and say your earnings, dividend saved. If these guys had converted, we would have saved on dividends. How are we getting it? It is 6% of the 1M. Remember, we are paying at a rate of 1 million, at a rate of 6%. Multiply that by 6/12, plus, after 6 months, 600 converted. 600 converted. I hope you remember. Then we said we remain with 400, which is 6% of 0.4M times another 6. Maybe I can put it so that I have enough space. This will be 6% of 1M times 6/12 plus 6% again of 0.4M times another 6/12, which you gave us, which we got 42. I hope you remember that we got as 42,000. That we got as 42,000. That becomes our incremental earnings. That's what we paid as dividend. So under the column of the incremental earnings, worker 42,000. We don't have to recalculate again. It is the same dividend we paid this year that otherwise I would have saved. Same dividend. Then we now go and compute. If these guys had converted their debentures, their preference, in 2012 when we were issuing them, what would have been the number of shares to be issued? Listen again. Now, so it means 1 million shillings, 1 million shillings of the preference remained potential for 6 months, and another 400 remained potential for another 6 months, for another 6 months. Okay? So these 1 million that remained potential for 6 months, just like we have discussed for loan stock, this 1 million that was potential for 6 months, how many shares would have been issued? Then after 6 months, this other 400 that will remain in potential, how much would have been the number of shares issued? Because 600 converted, so we are not going to use them again because they are no longer preference, they are now ordinary. So on 1 million, how many? Okay, but andika hivi number of shares first, number of shares. But don't forget, we said when you are calculating the number of shares, we were not using the basis of shillings like we did for loan stock. This time walisema, for every one preference, you get how many ordinary? For every one preference, you get 2 ordinary. Listen, let's go back. Our company began the year with 1 million shillings. I hope you can see there, shillings 1 million. Shillings 1 million of the convertible preference. Shillings 1 million of the convertible preference of 10 each. But now, when I'm computing the number of shares, the basis of conversion is for every one preference you have, you can get 2 ordinary. So I cannot say, what about 1 million? Because 1 million is shillings. Get my point there. 1 million is shillings, not number of shares. It's not like the convertible where we're saying for every 1,000 shillings, you get 300 ordinary. What about for 20 million shillings convertible loan stock? That way we were using conversion on the basis of shillings. Now we are using conversion on the basis of numbers. So where they are using numbers, you convert to numbers, not shillings and numbers at the same time. No. So for every one share, for every one preference share, you could get 2 ordinary. What about how many shares? If we began the year with 1 million shillings of the preference, 1 million shillings of the preference, and yet one share we were told had a par value of 10 shillings, how many preference shares will amount to 1 million shillings? If one share had a par value of 10 and the company had a share capital of 1 million, then it means the company had 100,000 shares by the beginning. I hope you are listening. Yes. Then we are saying, for every one preference you get, for every one, you get 2 ordinary. What about for the 100,000? So it will be 100,000 times 2 divided by 1. Listen, it's 100,000 divided by 2 times 1. But that 100,000 remained only potential for 6 months. So you multiply this by 6 over 12. After 6 months, 600 shillings converted, which we saw was 40 or 60,000 shares. So tukabaki na 400,000 shillings. But again, how many are those in terms of shares? One share had a par value of 10. 400,000 shillings are remaining. That gives me 40,000. So we come and say plus. For every 1,000, for every one share preference, you get 2 ordinary. What about for your 40,000 that was remaining as convertible for another 6 months? It will be 40,000 times 2 divided by 1. So somebody now can give us all that. What becomes the incremental number of shares now? 100,000. I hope you are getting where I'm getting 100,000. I don't use 1 million because now we are not converting on the basis of millions or shillings. We are converting on the basis of numbers. That's important. Good. So what are you getting? 100,000 times 2, that's 200. For half a year, that's 100. 40 times 2, that's 80. Divide by 1, that's 80. Oh, sorry. This should be for another 6 months. Sorry. This should be for another 6 months. Sorry. That should be for another 6 months. Sorry. Because it is for another 6 months remaining. This is times 6/12. Sorry. Now give me the amount. A 100 times 2, that's 100. 200 times half, that's 100. Then the other one is 40 times 2, that's 80. Half of 80 is 40, so that comes to about 140. So under the column of incremental number of shares, Weka 140. Weka 140. Now get me the incremental EPS now, so that we do the ranking as the last item. So 42,000 divide by 140. I'm getting 0.3 as the incremental earnings per share. Now you can rank them. As we come to the end, now we can rank them. Okay? So how do you rank them? Starting with the most dilutive. And we said the most dilutive is the one with the lowest incremental earnings per share. The one with the lowest incremental earnings per share. And it seems to be partly paid. That will become number 1. That will become number 1. Okay? As the ranking. Then after that, the next most dilutive looks like Convertible Preference upper chini. No, 1.2, 0.21, that looks like number 2. 0.21 looks like number 2. Good. Then finally, 0.3 becomes the last one. Okay? Now that we have done that, now we can start diluting now. Good. Let's now pre-do the diluted EPS now. Let's do the diluted EPS as we come to the end of the question now. You remember we said you need a table again. So you come and say earnings. You need to come and say number of shares and EPS. We want to start diluting the basic one. For basic, you don't repeat it again. We already computed it. It's only that we bring it here so that we start diluting it. And our basic, you remember we got earnings of 4. I can see it here. 14,558,000. That's what we got. Now we take it there. 14,558,000. Our number of shares was 7,272,000. If you remember, 500. Was it the same one? Let me confirm. Yes, 7,272,500. Then we got an EPS of 2.02. That's what we got. Now we start diluting it. Why? Because this time I told you there is no discontinued operation. So whatever earnings will tumia for basic is the same one you start diluting. Otherwise we said if kuna discontinued, you only use the earnings attributable to the continuing operations only. So the first one was which one? What was the most dilutive? Partly paid. Good. So wake up, partly paid. These guys will bring in the balance in the future. Will our earnings change? We have seen the incremental earnings will not change. No. But how many shares will be given as bonus? We saw 30,000. We saw 30,000. From the table I can see it here, 30,000. Good. Where are your 30,000? If that happens to be the case, our earnings will still remain 14,558,000, and this will become 005. We are adding, that is 52037. I hope I'm right. Yes, now divide those two. Now divide those two. Give me the incremental earnings per share now. No, the diluted EPS, sorry. Give me the diluted EPS. take that amount, okay, I am getting 1.99. 1.99. From there, we go to the next most dilutive, and the next most dilutive after that, according to our ranking, was convertible loan stock. That was number 2, convertible loan stock. And we are seeing that it will give us an extra earning of 680, 670, 333. Weka. So loan stock. It will give me an incremental of 670, 833. That's what we have seen. What about the earnings, the number of shares, sorry? We saw it will go up by how much? By 5 million. That's what we saw. 5,750,000. 5,750,000. 5,750,000. So this will come to what? Add those. This is 3, 3, 8, 8, 2, 2, 5, 1. I hope so. Otherwise, this will be 0, 0, 5, 2, 5, 0, 13. Am I right? Yes. Then get the diluted EPS now. Divide those two. Get the diluted EPS now. Get those two. I'm getting something like 1.77. No, 1.17, sorry. 1.17. That's what I'm getting. Finally, I go to the last most dilutive. And the last one was which one? Sorry, let me go back. The last one is what we got as the convertible preference, sorry. Convertible preference. Earnings will increase by 42. Number of shares will increase by 140. So let's put it. The couple preference shares. This will increase by 42. This will increasing by 140. That's what we have just seen. So this will be 3, 3, 8. That is 0, 7, 5. No. 2, 5, 1. Yes. 15,270,833. Yes. This will become 0, 0, 0, 0, 5. That is 2, 9, 1, 3, 1. So get the diluted EPS now. Get the earnings. Okay, I'm getting an amount of 1.16.